All right, let's dive into one of the wildest corners of finance, where the numbers just don't seem to add up, at least not in the way you'd expect. We're talking about the magic math of real estate.
So get this. Just imagine for a second you own a $10 million apartment building. It's doing great, the value is climbing, but when tax season rolls around, you get to legally tell the IRS that you actually lost almost $300,000 on it. How in the world is that possible?
And this is where it gets really wild. In the real world, your asset is worth more and more, but on paper, for tax purposes, its value is dropping like a rock. And these two things are happening at the exact same time for the same building. This isn't a mistake, folks. It's a very intentional strategy. So let's unpack what's going on here, this $10 million paradox. How can one thing be a huge winner and a huge loser all at once? Well, the secret, as it often is buried deep inside the tax code. I mean, just look at that number. $290,000. And let's be super clear, this isn't money that actually vanished from your bank account. It's what's known as a paper loss. It's a phantom number that exists for one reason and one reason only, to slash your tax bill. And believe me, it works. So how do they justify this? Well, the secret isn't some ridiculously complex financial gobbledygook. It's actually way more down to earth. The source material for this explainer puts it perfectly. It's all because of things like dying toilets and dead carpet. Now stick with me here, because this is where the real magic happens.
Okay, time to pull back the curtain and really explain this magic math. It all comes down to one single core concept from the IRS that unlocks this entire strategy.
And that big idea is called depreciation. You know, it actually makes a lot of sense. The IRS knows that buildings, and all the stuff inside them, don't last forever. They wear down, they get old. So the government lets property owners deduct a little bit of that wear and tear from their income every single year. And here's the key. Depreciation is a non-cash expense. Your building is losing value on paper, not out of your pocket.
But this is where the pros really take it to the next level. See, they don't just take the standard, boring depreciation deduction. No, they use a seriously powerful technique to supercharge it. It's a mouthful, but it's called cost segregation.
So, what does that actually mean? Well, instead of looking at a building as just one giant single thing that slowly wears out over decades, the strategy is to bust it open, figuratively speaking, and treat every single piece as its own separate item.
And this is basically what it looks like. Yeah, you've got the main structure, the big concrete box, but you've also got the electrical wiring, all the pipes for the plumbing, the light fixtures, and, yep, that dead carpet we were talking about. Every one of these things gets separated out for tax purposes. And this is why it's a total game changer. The IRS is smart. They know the concrete foundation of a building is going to last a whole lot longer than the carpet. So the building structure itself, that depreciates super slowly, over 39 years. But things like carpet, cabinets, and fixtures, you can write those off completely in just 5 to 7 years. By separating them, you get to claim those deductions way, way faster.
Now, the process itself is pretty straightforward. First, you hire a specialized engineer to do what's called a cost segregation study. They literally walk through the whole property and identify and classify every little thing. This lets you accelerate all those wear and tear deductions, cramming them into the first few years you own the place, which in turn unlocks absolutely massive tax savings right away.
All right, so that's the theory. But what does this mean in actual dollars and cents? Let's talk about the real-world financial payoff, because this is where it gets fun. Check this out. On that same $10 million building, if you just did standard depreciation, you'd get that $290,000 write-off. Nice. But with cost segregation, your year one deduction skyrockets to $950,000. That huge difference means you save about $350,000 in actual cash that would have gone to taxes, all in the very first year. It's an absolutely incredible financial lever. Honestly, the source material we looked at for this explainer just says it all with this quote. I love this. Your building gets weaker on paper, but your bank account gets swole. That perfectly captures the entire idea in one sentence. A loss on paper creates a very, very real gain in your wallet. So now that we get how it all works, it kind of brings up a bigger question, right? Is this just a clever trick, or is there something more to it? Let's zoom out for a second and look at the bigger picture. So, what do you think? Is this a brilliant, totally legal tax strategy that the government created to encourage people to invest in real estate, to build new things and maintain properties? Or
Is it a complicated loophole that mostly just benefits wealthy investors who have the money to hire the fancy engineers and accountants to unlock it? The tax code allows it. That much is clear. But the answer to that question? Well, that's definitely something worth thinking about.